Morning, everyone. This is Tim Melvin of Banking on Profits coming to you from what is a decidedly dreary day down here in Central Florida. It seems we had a little Tropical Storm Emily popped up last night and is kind of moving on over this way from the Tampa direction. My crazy Tampa friend is currently out surfing at Venice Beach to celebrate his 61st birthday. So happy birthday, Jeff, and I hope you enjoy the waves over there. So we've got the front edge of the rain coming through. We're supposed to be rainy anyway. I guess we'll get a little bit of wind along with it. Yeah, no big deal. It's living in Florida in the summertime. So anyway, since we last got together, we had a Fed meeting, and the Fed did not raise rates. Nobody really expected them to. Had some positive remarks about the economy, about the job market, but the report still contains that key language where they really expect Fed funds rates to remain lower than normal for an extended period of time. So, the economy's it's kind of moving along. There was a decent GDP report last week. Nothing in there to really pick apart, but it wasn't fantastic either. And for every good report, we get a bad report. So it's kind of a mixed bag as far as the economy goes. We are growing. We're just not growing very fast at this point in time. Some of the, Fed watchers, the bond market vigilantes, don't even think we'll get another interest rate increase in December because they expect continued slowing. I have no idea. I do know that from a banker's perspective, there's not going to be enough in the way of rate hikes to steepen the yield curve to really give a boost to banking profits based on net interest margins. Everybody had hoped it would be higher by now. Of course, we also hoped that there would be meaningful progress on regulatory and tax reform. None of that has been happening so far in 2017, and not sure about how the Fed will go, but I can tell you, looking at Washington, D.C. and watching this circus on television, yeah, I don't see it. The political parties are, again, they're playing for their team and building up points for the Democrats or points for the Republicans. What they're not doing is anything meaningful that's going to boost the American economy or make the banking industry better or lower our taxes or doing any of the fun stuff, ending some of the troop involvement around the globe. None of the fun stuff that might actually mean something to the people that elected them. They're just scoring points. So they'll score points. We'll wait patiently and hope that maybe towards the end of the year and into 2018, we can see some progress on tax reform and regulatory relief that will actually boost the profits of our small banks by as much as 30 to 40% over time. So we'll see how it all plays out. In the meantime, we'll just kind of sit around and wait for the tropical depression to roll through here a little later on today. Now, lately, when I go to pick up my weekend papers, I've been picking up the weekly edition of Investors Business Daily, IBD. Now, that's really been more of a growth stock investors newspaper, and that's exactly why I decided to start reading it again, to pay attention to what the growth folks are saying out there and what sectors they love, what sectors they don't love, what are the hot trends in society that we might want to take advantage of at some point, what's going on where. And they do a great job of that. They do a much better job than, say, the Wall Street Journal. The IBD Weekly is very upbeat, it's very positive. They've got a growth investor's view of the world, and it's kind of fun to read. One of the things I've been doing is something I used to do years ago. I'll go through all the stock listings in there, and the IBD breaks things down into a composite rating, a earnings strength rating, and a relative price strength rating. The higher of all these, the better. So naturally, what I do is I invert. I go and I look for the worst possible, the single-digit relative strength ratings, the stocks that are just really lagging the market, that the institutions, the larger ones, have just been selling and selling and selling. And in spite of the perpetual rally environment that we're in, these stocks have actually been going down. This is a great exercise. It's a way of building a shopping list. It's a way of looking for what Michael Steinhardt used to call variant perception. Where are people selling a stock, and maybe their reasons just are not entirely correct for dumping this particular stock. We can put the stock on the watch list. Maybe it'll fit all our criteria and we can buy it, but that's pretty unlikely with a stock that's in a free fall. It's not going to have the type of characteristics that we like to see outside the banking world. But anyway, so looking on there this week, just some of the names that popped up. IMAX Theaters has a horrible ranking. They're blaming it on the fact that they've spent a lot of money to expand the number of theaters, and the summer box office has been terrible. There has not been a blockbuster movie yet this summer, although it is looking like Dunkirk may, and more on that later, may in fact be that blockbuster for IMAX. We'll see how that plays out, if it makes the next quarter's earnings any better whatsoever. IMAX, it has, financially, this is a pretty solid company. The numbers look okay, but it's still just a little richly priced, for a true deep value investor. But looking at that, they just need better films at the box office for business to get better. They have expanded. They're moving into China. There's some very positive things going on there, and there's some very interesting people buying the shares at this point in time. So then we look down at TripAdvisor. I've never understood TripAdvisor, never got how it was a hot stock in the first place. It's just a travel website, and there's a ton of travel websites. I book most of my travel. I book all of my travel online these days. I've never used one of their sites, so I don't know how that stock ever got hot in the first place. It's still, to me, unreasonably valued. It's being dumped by some smart institutions. I just couldn't possibly see a reason to buy a stock like TripAdvisor. The one that did catch my eye, and it's kind of interesting, Chicago Bridge and Iron, the big contracting firm. They've got some problems with 4 projects, a couple of them in the liquefied natural gas, LNG markets. That are probably going to be a problem. They're going to be in a loss situation on those contracts, but eventually they'll end. Eventually, we'll see demand for infrastructure spending come back into place. They did sell their services division for, I think it was $700 million that they're just going to use to directly pay down some of their outstanding debt. So that should shore up their balance sheet, make their credit profile look a little bit better. Again, just a little rich, but it's a fun exercise, and you can see some of the things going on in the economy. When you see TripAdvisor falling out of bed, you ask yourself, are people traveling less? With Chicago Bridge and Iron, a lot of those contracts are coming from the big energy companies, big business, big government. Are we still seeing this delayed capital expenditures by business and government? And it looks like maybe we are in some parts of that market. And then with IMAX, are people really going to the movies less? That would indicate to me that consumers are not all that comfortable and not as happy as some of the recent surveys. But we're just going through the paper like that, picking out those single-digit relative strength stocks and asking yourself, what went wrong? What does it take to make it better? Should the stock be on the watch list? Is it going lower? What are insiders doing? Are they buying? Are they selling? Insider selling as the stock is falling out of bed is a horrible sign. That's a huge red flag to me. So just going through, maybe you pick up some ideas, but it's really just kind of a thought lesson. Going through the paper, looking for what's absolutely not working out there, and asking yourself what might make this better. So anyway, Barron's this week, always a hit. James Montier, one of our favorite folks to listen to over at GMO Asset Management, author of several fantastic books on value and behavioral investing. If you haven't read his books, go to Amazon right now. He's got a little book on behavioral investing, makes you pretty familiar with it. And from my mind, his value investing book is a classic that should be on everybody's bookshelf. So check those out on Amazon today. He was just talking about the same stuff that he's been talking about all year, quoting Winnie the Pooh again. Never underestimate the value of doing nothing, which we here at Banking on Profits we excel at doing nothing for long periods of time, as my subscribers will know. And we do it because it's extraordinarily profitable for us to do so. He talked about the value of cash. That's something I've talked about for the last couple of years. Cash has a high option value. If you've got a ton of cash, when the market does inevitably, I don't know when, guys, but it's 26 times earnings. It's been going straight up for 8 years. At some point, it will go lower. When it does, if you have cash, you've got the seeds of a new fortune. Remember, fortunes are made in bad markets, not good ones. So he also the GMO, he talked about expected negative rates of return in the S&P 500, said it was the worst looking asset class in terms of expected 7-year returns. So not real positive on the large cap blue chip stocks, a little bit more on micro cap US stocks. What they really like right now are deep value emerging market stocks. Not sure I'm that brave, but we'll look into it, see if there's maybe some way to gain exposure. But my temptation at this point, I'm all small banks and cash at this point. I absolutely love that position. The banks are doing extraordinarily well for us, and we expect that to continue. And one thing we did notice in that IBD review process is that all the banks that are listed in the paper, including some of ours, all have fantastic EPS rankings. They have solid relative strength rankings and decent composite scores because, in spite of the headwinds, in spite of the fact that Washington can't get anything done, as Jamie Dimon pointed out, industry in the U.S. is growing in spite of all that at about 1%, 1.5% a year. The small banks are taking share from the larger banks. They're servicing their community. They're seeing some loan growth. Excuse me. And so they're doing a good job. They're buying back stocks. They're raising dividends. We're seeing that in the earnings reports as they come out. So good things are happening in the small bank world. We love our positions. We don't have any anymore that are what I would think tremendously overvalued. We sold a stock last week at over 2 times book. Not because we had bad thoughts about the bank, but because I'm allergic to owning banks at over 2 times book. So we had to let that one go. Also, Barron's, Marko Kolanovic was out, following up on his research note from last week, addressing the fact that there's too much money chasing volatility-based strategies. That's on the heels of Jim Moody at Ballpost saying something very similar last week. And I will say that a lot of these volatility-based strategies, they remind me an awful lot, and Mr. Kolanovic pointed this out in his report, they remind me an awful lot of portfolio insurance back in 1987. And again, when we do start seeing some selling in the market, reversal of these vol strategies is going to make things a lot worse. So, by the way, will the impact of forced ETF selling. $1 trillion in passive investing these days, and there's no buyers if they all decide to sell. Passive investing strategies do not hold cash. If they're all selling, there is no natural buyer in the market, except for guys like Ballpost, to a degree, people like myself, that buyers are last resort. But as I said last time, the price we're willing to pay is a lot lower than the current quote. So when's it going to happen? Don't know. Will it happen? Oh yeah, at some point in time. Until then, we hide out in small banks and our little cash stockpile here. We are starting to see some 13F filings coming through. Only 1 or 2 of significance that means anything to us. Joe Stillwell, Stillwell Value followed his. We'll be talking about that in a newsletter later this week. What I do see, because I randomly go through these things. I'll go onto the web and I'll just pull up the website at sec.gov and I'll start scrolling through 13F filings. And there's a ton of closet indexing going on out there. There's a lot of people that are paying 2 and 20 or 1% flat fees for what's basically just a closet index fund with some minor tweaks around industry group and sectors. I'm not a fan of indexing. I know that it's the lazy person's way to invest in the market, and it's all the rage. It's not what I do. It's not what I advocate. I think, as Ed Thorpe said, I think if you're willing to work harder, you can do better. Most people aren't willing to work harder. So, but to be paying 1% or even 2 and 20 at a hedge fund for just a closet index that you can get for 10 basis points from Vanguard, Schwab, BlackRock, one of the other index fund giants, is just insanity. If you're having your money professionally managed, go through that portfolio and check it. If you own the stocks in a professionally managed portfolio that everybody's talking about on TV and that everybody owns, really, you might want to take a closer look. You've probably got a closet index fund and you're paying way too much to have your money managed. I've been going through these randomly for years now. It's really been an eye-opening exercise of exactly how wealth is managed in the United States. And most of it's just closet indexing, tweaking around the S&P 500 stocks. The number of guys doing real research and digging for real opportunities, I think, is becoming smaller and smaller and smaller as time goes by. Wes Gray had a great piece that we sent out as part of our reading list this last week, talking about the replication strategy of the indexes. And by the time these guys get done mixing and matching all these different ETFs and index funds, you should have just bought the whole market index, because that's what you've got. So anyway, a lot of money being paid for not a lot of management. So if your money's being managed, check it out, compare it to the S&P 500, see if maybe maybe you should be in an index fund rather than paying 2 and 20 to have an index with minor tweaks. So anyway, reading front this week, did mostly recreational. We did finish The Asylum, okay, which is about the early days of all the way up through the eventual sale of the New York Mercantile Exchange. And that is just a fantastic read. I mean, that place was like the wild, wild west of finance, particularly as the oil markets started to evolve. So it's a story of how they go from this potato trading exchange basically in the 1970s to controlling the global price of oil. Just a fascinating story, lots of wild characters, and just a fantastic read and a real lesson in finance gone amok. So pick that one up. It is on Amazon, and it's a fantastic read. Also, I've read several in the last week of the Marcia Clark novels. Marcia Clark, for those of you that don't remember, was one of the prosecutors in the O.J. Simpson case. They totally blew that case. Fortunately for her, she's a pretty good writer. She tells a really good story about LA area DAs and police officers. Usual kind of mystery, whodunit type of thing, but good reads, lots of fun. I think I read 2 of them this week, and I got a couple more lined up to go. And she's got a new one coming out in August. So, also just started David Hardy's Palmetto Empire. Written several years ago, but it's about the early history of Florida, Andrew Jackson bringing U.S. troops down here, the Seminole Indians, and just kind of the wild, wild west days of Florida. I guess we could call it a cracker western, and as we all know, I love those books. I think they're fascinating. You get a great story, just like Louis L'Amour, but you also learn a lot about the early days of Florida, and I think that's pretty cool. It's an interesting place. Okay, trade deadline coming up in Major League Baseball today. Who's going where? Where's Yu Darvish going to go? How about Sonny Gray at the A's? That could be a fantastic. He's under contract for 2 more years. Yu is just arrested. Darvish is just a rest of the season rental in all likelihood. But Sonny Gray's under contract for a couple years, so that could be huge if somebody is able to trade for him. Billy Beane's asking for a lot. I suspect he'll get it. I suspect Darvish, he's going to look great in either New York or LA because I think that's where he's headed. The Cubs made a couple moves, got some help at catcher where they needed another catcher, and they got some help in the bullpen, which probably needed a little bit of help as well for them to make the run they need to make. Now, the hottest teams in baseball the last couple of weeks, the Yankees, the Miami Marlins. How could they not be hot? Giancarlo Stanton hitting .289 with 12 home runs and 23 RBIs in the month of July. And that included some moonshot home runs that might not have landed yet. So he's getting hot as the summer gets hot. Miami is now second in the National League. Unfortunately, they're about 9.5 games out of the wild card. So for them to have a shot at the playoffs, somebody's going to have to collapse because the Nationals continue to just sort of run away with the division. So the Cubs and the Dodgers over in the National League, both still hot. Looks like Cubs are making the move I was hoping they were going to make. They've got about, I think, a 2.5 game lead over the Milwaukee Brewers right now, but they're playing fantastic baseball, and they made some moves at the trade deadline to make the team better. So hopefully they'll make a nice run, and my record of picking division winners will remain intact again this year. So we'll see. The Orioles, that's 500 ball. We can beat teams based in Texas, apparently, and we do pretty well with the ones based in Tampa. Haven't done much with the rest of the American League or the National League, for that matter, so far this year. Coming into a tough stretch in August, starts to get interesting. We should have traded a lot. I'm hoping they'll move Zach Britton at the deadline today. They won't. They should have moved Manny Machado because I don't think he wants to be in Baltimore when his contract's up. We could get somebody's whole farm system for Manny Machado, but we won't. And, we'll be lucky, I think, to stay out of last place because Toronto has won 8 of their last 10 games, and all of a sudden, here come the Blue Jays. Very talented ball club. Could easily push us all the way to the back of the pack. I hope not, but it could happen. So we'll keep watching. We love the game, even when we don't agree with the stuff that the front office is doing. And the Orioles do still have some pretty exciting bats in that lineup. Jonathan Scope, as I said early in the year, well on his way to becoming a superstar in the game. So we'll keep watching. We'll keep hoping, but it really does look like it will probably be the Red Sox although the Yankees are hot, and when the Yankees get hot, if they can run into the Red Sox, they could mow them down. And it could. So Yankees are the Red Sox for that division this year, and obviously the Houston Astros out in the West are continuing to just run away with the American League West. So fun times getting into the home stretch of the season. Looking forward to some great baseball as we start to really sort out the playoff and wild card picture in Major League Baseball. So that's really all I've got. Got a tropical storm going to roll over here, give me all sorts of rain. Going to have to get the dog out here for a bit of a walk so that we get that out of the way before the storms get here. And providing I don't blow away in said tropical storm, I will talk to you guys next week.